Oxford Nanopore Technologies missed consensus on top-line revenue, but delivered a massive beat on the bottom line. Revenue came in at $116.7 million, up 12.3% on a constant currency basis, but that was short of the $122.28 million estimate.
Yeah, but they absolutely crushed the profitability metrics. I mean, EPS printed at a loss of -5 pence, and that handily beat the expected -7 pence loss. Plus, their adjusted EBITDA loss narrowed by, well, 54% to $22.1 million.
Right. And management maintained FY26 core revenue growth at 16% to 20%, gross margins around 62%, and crucially, they reaffirmed that 2027 adjusted EBITDA break-even target.
Exactly. And the stock reacted violently to this. Shares surged over 16% intraday on those margin improvements before, settling higher by roughly 3.3%.
So we've got a stack of analyst notes alongside this earnings report for you today. And the mission for this deep dive is to figure out if these shifting unit economics are a massive warning sign or, a stroke of genius.
Because the market completely forgave that top-line revenue miss, right? And that's
Right.
truly because the underlying profitability is expanding so rapidly.
Right. I mean, gross margins jumps 400 basis points to 62.2%. You really don't see that kind of leap by accident.
No, you don't. The notes attribute this to updated pricing models, a 7% reduction in operating expenses, and flow cell recycling.
Okay, wait, but how much does recycling of flow cell actually save?
Oh, a massive amount. I mean, these flow cells aren't just plastic trays, right? They contain thousands of microscopic nanopores embedded in a synthetic membrane.
Wow, okay.
Yeah, alongside complex sensor arrays and precious metals. So by successfully recovering and refurbishing those high-value components from the used plates, they just drastically lower the cost of goods sold on every single sequencing run.
Which brings us to the core business model. For those following along, you can think of Oxford Nanopore as a high-tech razor and blades setup. The razor is their high-throughput sequencing platform, which is sometimes a $500,000 machine.
Right, a massive investment.
Exactly. And the blades are those biological flow cells required for every single genomic test.
Right, and the numbers show device sales surging 32.6%, while high-margin consumable revenue, the blades grew only 2.7%.
See, I get that the market likes margin expansion, but a 32% jump in hardware versus a sub-3% bump in consumables, that feels like a glaring mismatch.
It does look like one, yeah.
Are labs just buying these sequencers and letting them sit in a corner collecting dust? Because if you sell the razor but no one buys the blades, the whole model just falls apart.
I mean, it looks terrifying on paper, I'll give you that, but it actually reflects a natural CapEx lag.
Oh, really? How so?
Well, when a clinical lab buys a massive high-throughput sequencer, they don't just plug it in and start burning through flow cells on day one.
Right, that makes sense.
Yeah, it takes months to physically install the platform, calibrate the lasers and sensors, integrate the software with hospital records, and, actually train the staff.
Okay, so the hardware surge is really just a leading indicator.
Right.
And the consumable burn rate should naturally catch up once those machines go fully online.
Precisely. Routine purchasing just doesn't kick in until that validation phase is completely done.
Okay, but even if we forgive that hardware lag, they still miss top-line revenue. And when you break down the geography, you see exactly where they hit a wall. EMAI was strong, up 23.8%, and the Americas grew 12.5%.
Right.
But then they saw a 16% drop in China and a 14% drop in the Middle East.
Yeah, and those drops aren't from a sudden lack of scientific demand, to be clear. They are entirely driven by geopolitical and regulatory headwinds.
So it's not a product issue.
No, not at all. In China particularly, shifting trade restrictions and new local regulations that aggressively favor domestic biotech equipment over foreign imports are, well, they're freezing out Western hardware.
Which forces management to pivot, right.
Yeah.
If you can't rely on certain geographies, you just have to change who you sell to.
Exactly.
And we're seeing that in the segment mix. Clinical revenue surged 35.4%, and biopharma jumped 25%. Meanwhile, their legacy research division grew just 5.4%.
Right. So the CEO, Francis Van Parijs, is basically steering the ship away from academic research labs, which obviously have very tight grant budgets.
Right.
He's moving them toward high-value clinical and diagnostic applications where the funding is sticky, and he's using non-dilutive partnerships to accelerate that transition.
Like the cross-licensing deal they just announced with a global diagnostics company, that injects a cool $20 million upfront fee right into the second half of 2026.
Yeah, and since that's an intellectual property licensing fee, it drops to the bottom line at a 100% gross margin.
Wow, pure profit.
Exactly, it's pure profit. That single deal pushes their reported FY26 growth guidance up to a much healthier-looking 23% to 27%. That's massive. And they are mapping out a highly ambitious future, too. The new 2030 medium-term targets project over $700 million in revenue and greater than 15% adjusted EBITDA margins.
It's an aggressive roadmap for sure. They are betting heavily that scaling these clinical partnerships will generate enough, software-like margin to offset the physical manufacturing costs of being a hardware company.
Which leaves you with this final thought to mull over. Can a hardware-heavy business model truly sustain software-like margins in the cutthroat genomics space, especially if those geopolitical barriers in Asia become permanent? Make sure you follow the show for your daily deep dive into earnings coverage.